Rural bank defaults and boycotts have severely damaged the Chinese economy over mortgage payments. We shall learn more about China's mortgage crisis in this video. Approximately 40 billion renminbi in retail deposits were announced to be frozen by 4 rural banks in the Chinese province of Henan in April 2022. Within 3 months, several homeowners in China threatened to stop paying their mortgages on flats attached to ongoing development projects. Although the two incidents are not formally connected, many people see a connection between them. This is because the mortgage boycott started so soon after the rural banking crisis that now the mortgage crisis may have even been sparked by worries about the frozen deposits, and both crises were disproportionately concentrated in Henan. The population of this sizable, landlocked province in the Yellow River Valley of central China is just under 100 million, and its GDP is close to $1 trillion. This insight has 2 significant repercussions. First, the Chinese financial system has evolved over the past decade toward quite dangerous self-reinforcing borrowing patterns, as Chinese regulators are increasingly realizing. In reality, economists like Hyman Minsky, Irving Fisher, and Charles Kindleberger have long understood that these vulnerabilities are the natural and automatic result of many years of monetary expansion, rapid growth, and rising asset prices. Nevertheless, these vulnerabilities will be blamed on reasons specific to each case, such as lax oversight, forgery, and greed. Second, many analysts have suggested various solutions to the issues that China's rural banks, owners of unfinished apartment buildings, and the Chinese real estate industry in general are facing. But the majority of these claimed solutions don't actually fix anything. These ideas focus primarily on strategies to extend and restructure implicit and explicit liabilities to delay a problematic or chaotic resolution. Most of these extensions entail imposing repayment responsibilities directly or indirectly on regional authorities or on larger solvent institutions. Simply put, this is treating a solvency issue as a liquidity issue. But in China, unproductive investments in infrastructure and real estate and a persistent over-evaluation of real estate have supported years of fast debt growth. In other words, there has not been a corresponding increase in the economy's total ability to service debt. Given this situation, the only option to pay off the debt is through making implicit or explicit transfers to lenders from one or more other economic sectors. Taxes, defaults, financial restraint, inflation, wage suppression, or currency appreciation are all examples of these transfers. However, what distinguishes them is primarily how the costs are distributed. The cost-bearing party in the economy ultimately has to be one of the following: households, enterprises, local governments, Beijing, the agriculture sector, the tradable products sector, or another party. A political choice nearly always determines which sector must bear the consequences in the end, but this choice has significant economic ramifications. The authorities respond to the rural bank crisis. The Henan police reported significant development in the criminal investigations involving the 4 banks. By then, they had learned that the issues also affected Township Bank and Guzhen New River Huai Village in the adjacent province of Anhui. On July 12th, amid new protests, bank supervisors in Henan and Anhui, including the local CBIRC department, ordered partial payments to depositors. From July 15th onward, people who made deposits of up to 50,000 renminbi had their money returned. Regulators announced the reimbursement of a second wave of depositors a week later, with deposits up to 100,000 renminbi, presumably after finishing the previous batch of payments. They announced a third round of reimbursements for depositors with accounts frozen at up to 150,000 renminbi on July 29th. On August 5th, they announced payouts for anyone with accounts frozen at up to 250,000 renminbi. Were the deposits insured? Here's where things start to get a bit tricky. In late October 2014, almost 8 years ago, the State Council approved a deposit insurance regulation for Chinese banks that were supposed to take effect on May 1, 2015. Many experts initially believed that the 4 Henan banks' depositors would have protected up to 500,000 renminbi. Some depositors claimed to have put down much more money. Still, it was generally accepted that their fates would be politically determined, primarily based on how much noise they could generate and how unstable it might be for the financial system if wealthy investors with deposits exceeding the 500,000 renminbi limit suddenly became alarmed about the possibility of losses. As the mortgage boycott develops, we anticipate more actions in the coming days and weeks. There's little doubt that the accompanying risks to the banking system and the economy might be detrimental. With the all-important Party Congress only a few months away, Beijing will not want to see any disruption to the victorious narrative the Chinese Communist Party intends to tell the nation. That concludes today's video. Thanks for joining us till the end, and we'll see you in the next one. Goodbye.